Most people don't realize that when you put your money in the bank in America and in many parts of Europe, the banking laws say that you have relinquished your cash. They say, I have my money in the bank. No, you don't have real money in the bank. You had your money until you gave it to the bank, and now it's the bank's money. What you did was you extended the bank a short-term loan, and that short-term loan is unsecured.
Welcome to Rethinking the Dollar. Today, my guest, Mr. Reggie Middleton. He's an American entrepreneur who is the founder of Veritaseum, a peer-to-peer financial platform, and the finance and tech blog, Boom Bust Blog. Reggie has appeared as a guest on several news channels, sharing his expertise in market analysis as well as investment strategies. Some of his most notable commentary work has come with predictions on the housing crisis in 2007, as well as the collapse of Bear Stearns in 2008, and a lot of other events since then. So, Reggie, welcome to Rethinking the Dollar.
Thank you very much.
I appreciate you sitting down with me. As I mentioned before our interview, I'm a fan of your work. I've subscribed to your YouTube channel, and I saw your most recent discussions on the European situation, and definitely wanted to, get your take on that, because I think there's a lot of similarities with here at home in the United States, and so looking to get into that a little further. But before we get started, I'd like to ask some RTD questions, and the first one is, what comes to mind when Reggie Middleton hears the words "rethinking the dollar"?
I think to step into the 21st century, or what is known in the technical world as a paradigm shift. A paradigm shift is when things change so dramatically that the industry is shaken. The guys who are on top usually fall, and somebody who wasn't seen to be a leader at all climbs up to the top. And so in this paradigm shift, the concept of money is to be shaken up. And those on the top, most likely some of the large oligarchical style banking entities. I don't want to name any names, but think of the biggest, most powerful banks you could think of. They have a strong likelihood of falling off of their perch. The reason why we're rethinking the dollar is traditionally, almost since the beginning of the concept of money, money, with the dollar being a representation of money, has been static, has been basically dumb and not malleable. The money has taken the place of barter. So back in the caveman days, you have a caveman. He was a little stronger, a little faster, maybe a little smaller than the other cavemen. He had more cave girls, had a bigger club, and he gathered more things, more women, more nuts and berries, maybe more cattle, killed more meat. And with that excess, he was able to make deals with other cavemen and basically barter for things that he wanted that he didn't have. Eventually, carrying a mastodon on your back gets a little, no matter how big you are, it gets a little cumbersome. You crack a few vertebrae. So mankind thought of a more convenient way of transferring value versus things of actual need. So barter gave way to currencies. Currencies are representations of value that weren't necessarily the objects of value themselves. Think of Africa and cowrie shells, or the Roman Empire and the little drachma representations, pieces of metal, things that were probably commodities, or not that difficult to find, but were thought to represent something of greater value. And that's what the dollar is. Actually just a piece of paper, but represented something of more value. Up until 1973, theoretically represented a unit of gold. After that, represented basically the full faith and military might of the U.S. government. Still, just a piece of paper, though. Into the 21st century and the peer-to-peer economy, which is what I call it, and you have the ability to have money that can be programmed, like a computer application. Money that is a computer application, money that can be forced to honor the promises of those who released it or expect to receive it in a social, legal, or smart contract, thinking money. So I can now buy a Samsung S7 from you, brand new, gold, T-Mobile, Verizon, etc. I can give you the money, the smart money, and you can ship me, say, the silver T-Mobile S7. I get this S7 in the mail, I open the box, and lo and behold, it's really a iPhone 4 cracked screen from several years ago. And you have that smile on your face saying, I got that sucker. You got the money I sent in the old phone. You go to spend it and it won't spend. The reason is because the money is now smart. Using the dumb fiat dollar, fiat meaning backed by faith, once you got the money, spend it. You get the smart money, the rethought out dollar or currency, and because you didn't honor your end of the contract, the money doesn't spend for you. If you know that ahead of time, then you have no incentive to defraud me because you don't benefit from it, at least no financial incentive. If you didn't know that, you can't defraud me or you can defraud me, but you don't benefit from it. So now you have a reason to write the fraud. That's one of many aspects of how and why um, thoughts come to mind when your show Rethinking the Dollar is mentioned. Very good name, by the way.
Well, thank you,
Quite
sir.
time.
And you mentioned, two, labels that I never thought of before: smart money and dumb money. And so, being that the smart money, that the whole using technology now to be basically conduct transactions, is a new way of doing things. And so, we're entering a new era of finance and things like that. And so, in your opinion, how and why is it important for citizens globally to begin taking interest in finding out things about smart money and dumb money, in regards to their own personal finances and things like that?
Okay, basically, it's real simple. You have smart people, dumb people, and not to be condescending, but people who know will have more control over their destiny and future, and most likely more control over others' destiny and future than those who don't know. And that would be the new lines of demarcation, basically the new markers for socioeconomic might and control. Those who are aware of technological, economic, and geopolitical changes. Big fancy names for basically knowing what's going on.
Right, fair enough. Now, one question before we actually get into some of the European crises I want to cover and get your thoughts on that, as well as how it relates to here, is if you were given a chance to be at the podium, all TV channels are turned into the Reggie Middleton YouTube channel or RTD channel here, and someone asked you to give a clear, precise defining of the global state of the economy in an address form, what would it sound like? What would you tell people is going on globally now?
We're going forward to the past. That's the opposite of Back to the Future. If you remember that movie with, the crazy guy in the DeLorean.
Yeah.
In 2000, we had a significant bubble, fueled from about 1999 to about 2007. The bubble peaked and popped, and in lieu of allowing the bubble to pop and deflate naturally, where you have, a phoenix that rises from the ashes, those that caused the bubble and those that accumulated bad assets, profligate spending habits, profligate being basically wasting your money, and basically ill thought out management, were actually bailed out and saved. And because of that, these bad assets were never dissipated. The business habits and the business models were slightly altered, but never extinguished, and the problem was never put away. So the problem was concentrated in the banks that gave a bunch of bad loans, did a bunch of highly levered trades that were theoretical, not based in reality. The banks went bust. The sovereign nations, the governments, came to save these banks. Okay, when the government saved the governments get the vast majority of their income from where? Trick question.
Oh, well, they borrow from central banks.
They get it from the taxpayer.
Oh,
Basically,
right,
get it
yeah.
from you.
Yeah.
Okay, so when the governments go to bail out the banks, that means the taxpayer bails out the banks. They talk all the bad assets and the overpriced debt that was attached to underpriced or undervalued or overvalued assets onto their balance sheets. And now they've saved the banks, but now they've indebted themselves. So you went from banks being in trouble and bad companies being in trouble to governments being in trouble. And the governments were able to print their own money, change the rules of accounting, regulation, etc. So they're sick, but they simply put a sign on it that said we're not sick and went along, went about their way. The problem is putting a sign on that says you're not sick doesn't make you better. It just makes everybody look at the sign that says you're not sick.
Right.
Fast forward from 2007 to 2016, almost a full decade later, we're exactly back where we started from, except for one major difference. A lot of the firepower that was used to save the banks is no longer in existence now. And you can see the governments and the sovereign nations and the central banks attempting to kill this bad asset deflation, poor economy beast by shooting all these bullets at it. But nothing's happening because they're out of bullets, and the bullets that they did use did not work, obviously. So that's why you see things that you've never seen in the past. Permanent zero interest rate policy, reserve, basically setting interest rates to zero. That doesn't work. Over time, they go to NERP, negative interest rate policy, basically taking interest rates and driving them negative, meaning that if I borrow money from you, you have to pay me for my privilege of borrowing money from you. That turns fundamental economics and finance on its head, everything upside down. There's an incentive to borrow because you make money when you borrow. There's a disincentive to lend because you have to pay the person to lend the money. And a whole bunch of other things go wrong with that. It's very difficult to value things using discounted cash flow analysis, where you basically measure the money that you make from an asset or business, and then you put a risk factor on it and bring that the amount of measuring that money down to today's value, with discounted by the amount of risk that you think it would take to run or to have that asset. That discounting factor was always assumed to be positive. If you make it negative, then you throw the numbers totally out the window.
Mm-hmm.
Okay, so is everything super valuable because you're discounting it by a negative effect? The negative discount is a premium. So the riskier it is, the more valuable it is. Makes very little sense. Math is thrown out the window. And then you have perverse incentives. You have entities that want to borrow because you make money borrowing, you don't have to spend. You have entities that don't want to save because it costs you money to save. The reason you have NERP is because these governments are attempting to drive savers outside of savings. Mm-hmm. They want money to be forced into the economy. They want people to spend. They want people to basically make the economy a vibrant place, nirvana, utopia. The problem is, the only reason people will truly spend is if they feel comfortable spending. If you feel like you're in trouble, if you feel like you don't know when your next meal is going to come from, or you're afraid you're going to lose money, you don't want to spend. But the central bankers, for some reason, have totally, disregarded human nature and common sense and say, well, we're going to charge you money if you put the money in the bank. So if you try and save with us, you're not going to give all your money back. We're guaranteeing you're going to take a loss if you put your money in a savings account.
Wow. Now, as far as with the negative interest rates and people not being able to save, and they're looking to, I guess, do away with the high denomination euro note there. How do you think this whole cashless society is going to really affect people's saving and trying to preserve their wealth?
Well, you see how it plays out. You can possibly have a cashless society. You could go digital,
mm-hmm.
Like the peer-to-peer economy, but that doesn't necessarily make it cashless. A lot of people will still store and can still store their digital currencies in a physical denomination, a physical container, which makes it convenient to hand off. The European Union, those who are under the purview of the ECB, is an interesting experiment, will have to be forced to go cashless. The ECB is tempting an institutional run on a bank. I say that because their negative interest rates, which they've doubled down on, is a true expense to large institutions. You have an insurer, and their insurers are actually doing this. Munich Re is one of them, where you have maybe billions of dollars in cash, okay? Or definitely hundreds of millions of dollars or euros in cash. You have 500 million euros in cash, around off to $1 billion. Let's say they do, let's say they have $1 billion, and you're getting charged, say, a negative 2% interest rate. That's a significant amount of money.
Mm-hmm.
You're talking, 20, 30, $40 million. You do the math,
yeah.
Right? And that's a lot of money to pay somebody to keep your money.
Right.
Now, they're not getting loans. They're not borrowing anything. They're not getting a service. They're simply putting money in an account. So what Munich Re said was, we're not going to pay you to keep our money. We're taking our money out of your bank accounts, and we're putting it in the vaults. Okay? Now you simply pay a vault fee, flat fee, which is, minuscule compared to what they're paying as a negative interest rate. Now, I would suggest anybody who's paying a negative interest rate to simply take the money out of the bank account. You can take your money out of the bank account and leave it in the bank. Withdraw it out of the bank account, out of the savings account, put it in the safety deposit box or a vault, where the bank is still responsible for it. And now they can't charge you a negative interest rate on it. Most people don't realize that when you put your money in the bank in America and in many parts of Europe, the banking laws say that you have relinquished your cash. They say, I have my money in the bank. No, you don't have real money in the bank. You had your money until you gave it to the bank, and now it's the bank's money. What you did was you extended the bank a short-term loan, and that short-term loan is unsecured. You have no collateral for that loan. So you gave the money to the bank, put your savings account. The bank gives you an IOU. It says we will return this money upon demand or upon, say, 2 months, 6 months, if it's a CD, etc. If something happens to that bank, then your money can and quite possibly will lose. Now, it's also quite possible that there's some type of insurance scheme that will promise to make you whole. That does not always work. If you look at Cyprus, this entire education was made real to the Cypriots. Their banks were doing it badly. The banks were bailed in, where they took the savers and the depositors' monies to recapitalize the banks. And many of those depositors simply lost their money, whether it's over the insurance bailout or over the insurance maximum, or if I'm not mistaken, some of them didn't even qualify for the insurance. And so they took a total loss. And the reason is you gave somebody an unsecured loan. Now, there's nothing wrong with giving unsecured loans, but A, you need to know you're doing it. Most people don't. And B, you have to get paid for the risk that you're taking. 0.001% interest, 0.02% interest, negative interest is not compensating you for the risk of giving a risky business an unsecured loan. If you know hard money lending, loan sharks, you know what they charge for risky businesses. 16, 18%, 25%, broken kneecaps, the fee, it can get expensive.
Yeah.
But banks are getting, they're getting these loans close to free. I'll call this return-free risk, basically. You're taking risk without return. And that's a play on the economic concept of the risk-free rate or risk-free return. Theoretically, if you go to a government that can print its own money and has the full taxing power of the people, they can always raise money to pay you back. And so a U.S. Treasury is considered the risk-free rate. Not necessarily true. They can default, and there are many ways to default. They may not technically default, but they can inflate the money. They print more money. So you give the U.S. government, and this happened during the crisis, by the way, you give the U.S. government $100,000 of your savings, okay? And at that time, $100,000 was able to buy, say, an S55, Mercedes S55 Benz, turbocharged, twin turbo Benz, nice car, fast, luxurious, depreciates fast, wastes your money. But that's a marker to see how much it was able to buy at that particular time.
Right.
Assuming car prices and values remain constant, you fast forward 6-7 years, now it costs $136,000 to buy that same Benz. Okay? And the reason is because the US started printing more and more dollars. So they gave you 100,000 ones back. Okay, but those 100,000 ones were now worth about 82,000 ones because they printed more of them. Hence, each individual one is worth less. To break this down, you get a pizza pie, you want to feed all your friends in the room, there's 6 of you, okay? And it's enough to give everybody in the room 1 slice each. All of a sudden, one of your friends decides to jump on the phone and call, 15 more buddies over. Now you can have 21 people. You're like, dude, 21 people on that 1 pizza pie. And then one of the central bankers in the room says, don't worry about it. We can still feed everybody. Cuts the pie into 21 pieces. Now everybody still gets a piece of pie, but they're much hungrier than it should because each slice is much thinner, but it's still a piece of pie. So that's what money printing is, basically. Taking a pie and cutting it into more parts. The amount of value is the same, but the individual units have increased.
Right. Now, but the show being entitled, Rethinking the Dollar, I want to ask you a dollar question. The typical, dollar graph of the dollar from 1913, dwindles on down to, what it is today, which some say 3, 4, 5 cents of what it was in 1913, 14. So with the remaining couple cents, what are your thoughts and opinions on how much longer we have of the remaining purchasing power of that little bit of value, if you would say that? How much longer before it it doesn't really buy much, like a Venezuela bolivar or Zimbabwe dollar. Or do you ever foresee something like that happening?
No, because Venezuela and Zimbabwe aren't powerful countries. They don't have the reserve currency. The U.S. has a reserve currency. We get to do things that all the other countries don't get to do. A reserve currency, by definition, is a currency that the world does business in. When you buy oil, it's priced in dollars. When you buy gold, it's priced in dollars. Um, Historically, um, the country that gets to have the reserve currency just coincidentally happens to be the country with the biggest guns. So, the reserve currency by force, and that's, mankind, that's the way it works. Previous to the US dollar, the reserve currency was the sterling pound. Britain had the most powerful military, most powerful naval fleet and force, and so the reserve currency. And if you look throughout history, there's a time when the Roman Empire had the reserve currency. Reserve currency is always those who have the largest military might. When you have the largest military force and you feel that your currency is losing control economically, socio-politically throughout the world, you do have an option to fix it. And that's basically blowing up whoever's causing you the problem or taking economic value from those who have it to replace what you feel you don't have. Now, of course, the reserve currency changes hands over time, just like military might does, because that's what happens to empires. They grow, they get so large, they collapse upon their own weight. The U.S. as an empire, I think, will last a bit longer than a lot of the previous ones because now conflict is fought virtually.
Hmm.
I'm sure the last several significant wars we've had, the U.S. population wasn't aware of because it's probably done through computer networks and over the internet. Think about when Obama was elected and a couple of nations that weren't necessarily seeing things eye to eye with the U.S. Their dictators or their rulers collapsed,
Right.
allegedly through Twitter revolutions. Now, I think you should realize that Twitter revolutions probably hard to come by because Twitter's not that powerful, but Twitter backed by the U.S. government, CIA, NSA, etc.
Right. Now, Reggie, you've done so you've kind of predicted a couple of things in the past that kind of came true. What's on your radar now? What's some things that probably trouble you or have you really concerned where you're keeping your eye on it as of today?
Well, we have bank collapse in Europe. That's coming momentarily. Now, how well it can be concealed is a different story, but the banks are in very bad shape, and the sovereign nations that attempted to bail out the banks are in bad shape, primarily because they allowed the banks to grow larger than nations themselves. Imagine you have a son, and you're trying to pull him out of a precipice. He fell, and you're trying to pull him. You seem like a healthy man. Maybe you're 6'2", 215, 220 pounds. You're in good shape. His son is 6'6", 290, 310. You're trying to lift him up. He's bigger than you are. Now, what happens when you have six kids, right? Each one's bigger than the other, and you're trying to lift them all up. And those six kids ate, 14 others each because those kids were sick. And your recommendation was instead of trying to make the sick kids better or letting six kids pass on, I hate to be morbid, you say, listen, you healthy kids eat the sick kids, and now we have a healthy kid. No, you don't. You have a big sick kid because he ate another sick kid. And you're trying to lift all these up yourself. You are the sovereign nation. These big children that ate other children are the banks. You have banking institutions that have over $1 trillion worth of assets on their balance sheet. You have banking institutions whose, as a single bank itself, leverage assets are larger than GDP of the nation that they're domiciled in. The U.S. is guilty of one of these. J.P. Morgan, I call it, is the bank of the United Sovereign Entities because J.P. Morgan's assets are actually greater than a significant amount of GDP of many countries in the world. In Europe, that's exacerbated because you don't have one or two banks like that. You have several banks in each country where each bank individually has levered assets that are bigger than the country. The countries cannot arithmetically bail these banks out in cash. Even if they could, they can't bail all of them. And the way the banks work is banks take on significant risk and they lay that risk off with other banks. When they do business on a large scale, and they do business with other banks. They do business on a fractional reserve system using derivatives. Fractional reserve means I want to start a bank. I take $1 billion on, and I have $1 billion banking business, but we're doing it in cash. There's but so much money you can make charging interest, getting it back. I can make a lot more money if I take $10 million or $100 million, and then I'll borrow 900 million or a billion. Now I have a 10-to-1 leverage ratio because I'm only using 100 million of my own cash, but I'm using a million of somebody else's money that I borrow. Now, when I get 6% interest on a loan, I'm really getting 60%, return because only a million of it is my money. Now, that sounds good, especially when things go well. When things go bad, those 10 times gains, that 10-time leverage you get on the gains is now 10 times leverage on a loss. So if you leverage 10 times, you take a 10% loss. Normally a 10% loss means you have a real bad year, a bad day, you lost a certain amount of money. When you leverage 10 times, a 10% loss means it's the end of the day, end of the life, out of business. You have, if you leverage 50 times, like many European banks are, all you need is a 2% loss to be totally broke. It's possible to stay in business and be broke. You have a 15% loss, leverage 50 times, you're deep in a hole.
Mm-hmm.
And if you're that deep in a hole and you're a systemic institution that needs to stay alive or it brings the entire country down, well, now that entire country's in a hole.
Mm-hmm.
And if you have all the other countries, all the other banks in the country as a counterparty, and they're leveraged as well, when you're that deep in a hole, you now bring all the other banks down in the hole with you. And those banks are now bringing the country down in the hole, and the country now brings the taxpayer. So you see how there's a daisy chain effect.
Yeah, everybody's on the hook.
Certain types of banks that get in trouble, and the whole shebang goes. That's what happened with Lehman Brothers.
Right. So this sounds like some type of monetary collapse or, globally systemic type of failure of our entire system. And so I take it that that's why the smart money now is kind of transitioning to the online peer-to-peer lending. So let's get into the Veritaseum. How did that come about? And give us a rundown on what that is for those that aren't aware of the smart money that is now available for medium of transactions.
Veritaseum is a startup that I started in late 2013. And basically, it's a smart contract system, a wallet, a digital wallet that works on top of blockchain technology. Blockchain technology is the technology that makes Bitcoin work. As a quick overview of Bitcoin has gotten very bad rap in the media, but Bitcoin is a monumental invention. It basically allows two people in two different places to do business with digital money without being able to cheat each other. So I can spend a digital dollar here or Bitcoin here, and I can have a Bitcoin here and I can spend it, and then it's spent. The deal is done. You cannot take that same. I cannot take that same digital Bitcoin or dollar and spend it somewhere else in California, just because you didn't know if I spent it because it's digital. Because once I spent it with you, there's a universal database that everybody has throughout the internet and the world that says Reggie spent one Bitcoin or $300 worth of value. And once it's spent, it's done, it's recorded in this ledger that everybody can see. And I can't cheat it, I can't hack into it, I can't change it. That enables ultimate trust between any two parties, and those two parties don't have to know each other, don't have to see each other, and they don't have to vet each other for creditworthiness, how much money they have, etc. The ability to do business with somebody else that you don't know and trust them 100% is basically a new way of doing things. After reading about this and finding out about it, I've decided to create an entire system that allows people to not only spend money with each other around the world without knowing or trusting each other, but to program that money to replace the business models of a lot of things that we do in everyday life. So not only can you spend money, you can do the equivalent of a stock trade. You can buy IBM stock or the value of IBM stock for US dollars from a total stranger. You don't need a bank account. You don't need a brokerage account. You don't need a broker. You don't need access to the exchange. All you need is our digital wallet and the digital money, Bitcoin, which you can buy anywhere. You can also do things like do capitation, HMO, health insurance payments. You can do health insurance, property and casualty insurance. You can do letters of credit. You can do any value exchange, what I call ValueNet. Everybody has a copy of our wallet, which is essentially a web page. You can simply download it. We're still developing that portion right now. It's Java. You can drive in your car, and you can say you're very motivated. You're in downtown Detroit. You're trying to get home to the suburbs. There's a lot of traffic. Your wife's having a baby. You're very motivated to get through, but there's traffic everywhere. You can have your wallet through your car and your internet system on your phone, reach out to the 40 cars in front of you and say, I'm willing to bid money for you to let me get in front of you in traffic if you move over. So your maximum bid could be, say, $1.50, but you could set the minimum bid to be what, a penny.
Mm-hmm.
Okay, and the system will go back and forth and bid until the person accepts it. So if they accept it for, say, 25 cents, and there's no skin off there, all they do is turn to the left for 10 seconds to turn back over. You got bid in front of them that cost you a quarter. So theoretically, you could get home through traffic for $30 or $40. You get what you want. You get home to see your baby born. Everybody else says, hey, I just made $1 for basically nothing. I could afford the time. This type of value transaction and communication between the cars, smart cars can have this embedded in the cars themselves and negotiate amongst themselves. Driverless cars can do it. You can disintermediate Uber. Everybody can make their own Uber service by having the smart wallet and communicating with the Google driverless car saying, pick me up, et cetera, et cetera. You don't really need Uber to do that. Everybody already has a smartphone. You already have GPS. You have the payment system. You have a smart wallet. What's Uber for?
Cut out the middleman.
So three examples of what Veritaseum is capable of.
Right. So as we come out of the home stretch here, so do you feel that this is the future of finance? This will do away with the centralized nature of our banking system? I know that a lot of banks are building blockchain technology as well. So how do you see this playing in with what the banking system is trying to do as well?
The banks are building blockchain technology to bolster their back end and their settlement processes. Good for them, but if you don't need banks, it doesn't matter how well their back end processes settle. What an analogy would be, I'm taking newly discovered turbocharging technology and I'm putting it in a Corvette and I'm making a very, very fast car that you could get in yourself and drive. Banks are taking this turbocharging technology and they're putting it in horseshoes and they're trying to get the horse to run faster. Okay, no matter how fast the horse runs, I'm gone. I'm in the car. Everybody could drive themselves and you don't need to go and hire the horse and buggy to come pick you up, even though it's a faster horse because he has a turbocharged horseshoe. I'm giving everybody their own car that they can drive themselves, and it'll always go faster. Even if those horses eventually are able to go as fast or faster than the car, you don't need it because now you can drive yourself.
Fair enough.
Peer-to-peer technology versus old school heteronomous technology. Heteronomy means needing to rely on an authoritative figure, an authority to do business and make a decision. Peer-to-peer technology, Veritaseum, is autonomous, meaning power to the people, power to yourself.
Wow. Reggie Middleton, thank you for sitting down with us. Give the audience a chance to, follow more of your work and how to get involved with Veritaseum and get involved with some of the smart money technologies going on now.
Okay. Well, you can reach out to the site. I have analysis that I post every other day, roughly. Veritaseum.com, Veritas, Veritaseum.com, and go to the blog. I also tweet quite often at Reggie Middleton Twitter account, so you could go there. You can see the YouTube channel. I don't have it memorized, but search Reggie Middleton for YouTube. Subtitle, I forgot what his name. And you can see me on Facebook as well, where I do a lot of stuff, political commentary, a little bit more racy than simple financial economics. But many ways to reach me.
All right. Well, thanks for sitting down. Well, thanks for joining me. I definitely enjoyed the idea of dumb money, smart money. Definitely going to look into it more myself. And have a great day, and I look forward to staying in contact with you.
Okay, thank you.
Well, this concludes my conversation with Reggie Middleton. Hope you found the conversation to be informative as well as educational. I want to encourage you to visit Veritaseum.com to find out more about Reggie's work. Also, scroll below, leave us a comment. I would love to hear your thoughts on this interview. Also, click the subscribe button for more RTD interviews as well as monetary news updates. Looking forward to bringing you more interviews. Until the next one.